Welcome to Money with Mark Albert, where right now we're going through a smart money questions series where we handle smart questions to guide your estate, tax, and legacy plans. And so this is the third question of in this series. Now, this third question can be applied to life insurance, registered investments like RSPs, TFSAs. Although TFSAs, you've got the successor annuitant, successor holder concept that we're not dealing with here. It can be applied to RIFs and segregated funds. You could apply this to guaranteed investment accounts. So the named beneficiaries. So we're looking at this question: who should be designated as primary and contingent beneficiaries? These are the type of questions you want to ask your estate planner. Who should be designated as primary and contingent beneficiaries? And should they be named directly on the life insurance policy or directed through my estate or a trust? And it's a very good question that we're going to deal with here. And so there's different ways to set up the beneficiary. Obviously, you could set up as a direct beneficiary, so a named beneficiary. And of course, the benefit there is it's direct, it's a fast payout. It would bypass the probate fees and the probate process, which is a public record information. You bypass delays, the beneficiaries get it right away, and there's strong creditor protection because creditors can come after the estate, but by bypassing the probate, you actually bypass the estate as well. And so when you put a named beneficiary on a life insurance policy, they receive a lump sum tax free and right to the individual. And so this is best for adult beneficiaries, your spouse, of course, financially responsible adults, or charitable giving. So if you want to give to a registered charity, very, very proper way to do that. So also you could name the estate as the beneficiary. And so that would go directly to the estate and allows for centralizing the assets into one pool so that the executor can leverage it, use it for the purposes of settling your estate, and allows um, execution of complex instructions that might be in the will to be dealt with. Okay, so there are times where we have to maybe have the estate as the beneficiary. Also, dealing with all of the tax related costs and legal fees, accounting fees that may be associated with settling the estate. And so that's important to know. You can also give to a registered charity through your will. If you send the uh, resource, your money to the estate, and in the will, it lists a named registered charity and their registration number, you can get a charitable tax receipt, which is very beneficial for tax purposes, or maybe there's a cause you want to support, and that'd be good. So obviously, you can name the trustee or the trust as a beneficiary in this sense. This is helpful if you have minor children that you need to take care of, or disabled descendant, so a child or someone you want to take care of, or an adult beneficiary who's poor at managing money. So you want to consult with an estate planning financial guy, but just to make sure that's set up properly, and then obviously work with a lawyer on the language for the trust and the will. So also I put there registered charity because some people have a heart for philanthropy, and it's an excellent option to fulfill philanthropic goals or the tax benefit that you get. So sometimes on a capital property, you can donate it to registered charity, and then you won't just get the non-refundable tax credit, but you can also have it set up so that the capital gains tax is erased. It's set to zero. And so those are some questions that you should ask your estate planning, the estate planner. And so this is very good. Now let's look at choosing the primary beneficiary. So here's are the options, very good options here. Your spouse, common law partner, very, very common options. It's a tax-free amount they receive. And then, adult children, which is common when there is no spouse in the picture. And then a trust for minors. We've discussed that already. Charitable organizations. Notice I put the word registered there because there are some organizations, charitable organizations that are not for profit, but they're not registered charities. They're not registered with the CRA to give a tax donation receipt. And it's important that you confirm whether the registered charity or the charity you want to give resources to is in fact able to give that tax receipt. Otherwise, you will not have the tax benefit of doing it. Now, that's really important stuff, and there's sometimes confusion on that. So when we come about the contingent beneficiary, also known as a secondary beneficiary, and then you would use that the contingent beneficiary, they receive the payout only if all primary beneficiaries predecease them. Okay. And so sometimes, you would put your adult children, particularly if you have your spouse as the primary. Oftentimes people will consider putting a grandchild or grandchildren or siblings as well, and then registered charity for the same reason as above. So let's look at three very common scenarios. The first one, very common to put the spouse as your 100% named beneficiary, but then have the adult children divided equally, directly. Now, this is a common scenario with married with adult children, okay? So notice I put the word contingent. If you put the children, the per stirpes. So per stirpes has to do with it's a legal term, right? We don't use this every day, but it's about dividing resources equally among the person's offspring. So if a named beneficiary, if you have 4 children, they're all named, and one of them passes away, then if you set it up per stirpes, then that person who passed away, his offspring or his children would get the percentage that was allocated to him. The other way to do it is that it just forfeits that, and that's per capita, where it just goes to the remaining beneficiaries, gets split equally among them. So that's a very common scenario with married with adult children. So if you're married with young children, another common scenario here, 100% to the spouse as the primary. And then in the secondary beneficiary, that is often, you look at the testamentary trust that is set up in a will, and or you have a living trust that's already set up while you're alive, and then you would direct those resources to go into the trust, either through the will or the named beneficiary as the trustee for the trust. Just seek legal advice on that to confirm that you're doing it properly. Now, sometimes when you have young children, they will name an adult, and instead of setting up a legal trust, they will say in trust for. So those are two very different things. So ask your estate planner about the difference of those two. And so, because they are very different, okay? And I'll leave it at that for now, and I'll address that on another video. So another common scenario in a blended family situation or complex asset distribution is, you would set up a spousal trust so that when you pass away, resources go to the spouse, and then you have the instructions so that when that spouse passes away, it goes to your biological children. Okay. You could set up a formal trust structure. Also, these are the type of things that would require you to seek an estate planning lawyer to make sure the legalities, the trusts are set up properly, and so on. And that would be great. So, sometimes you have questions about these estate plannings. I'm available. Obviously, I'm in Ontario, but my contact info is there if you want to reach out to me. Trust has been helpful. Thank you so much for being with me, and have a wonderful, wonderful day.